All right, let's talk about one of the biggest gambles in the business world, the high-stakes, high-risk search for stuff like oil and gold. Today, we're diving into the financial rules for these modern-day treasure hunts. It's all about a standard called IFRS 6.
So, think about this for a second. A company can pour billions of dollars into drilling for oil or digging for gold, but what if they actually got to show for it before they strike it rich? Is all that money just gone, an expense? Or is it somehow a valuable asset? How do you put a price tag on a maybe? That's the huge question we're tackling.
Okay, first up, the great accounting gamble. Or how do you value a treasure map? Seriously, before we had clear rules, this whole thing was a total shot in the dark. Imagine you've got this map. Is it just a piece of paper? Or is it the key to a billion-dollar fortune? For companies, and maybe more importantly for their investors, this kind of uncertainty was a huge problem. And yeah, for a long time, it really was the Wild West. I mean, you had some companies writing off every single penny spent on exploration as an expense. Boom, right off the income statement. Then you'd have another company doing the complete opposite. They'd capitalize those costs, making their assets look bigger on the balance sheet. Now, if you're an investor trying to figure out which company is a better bet, good luck. It was like comparing apples and oranges. It was confusing and, frankly, pretty risky.
All right, Section 2. Enter IFRS 6, the rule book. This was all about bringing some order to that chaos. So to sort this mess out, the International Accounting Standards Board stepped in. They created a very specific set of rules, and they called it IFRS 6. Let's get into what it actually does.
So this all happened back in 2004. That's when the IASB rolled out IFRS 6. And look, this wasn't just some minor update. It was a direct answer to all that inconsistent reporting that was just driving everyone crazy. The goal was to level the playing field, to make sure that a dollar spent exploring in one part of the world was treated the same as a dollar spent somewhere else. This was a huge deal for making things transparent and, well, comparable for anyone looking at these companies. So what exactly are we talking about here? IFRS 6 is super specific. It covers the exploration for and evaluation of mineral resources. In plain English, that's the search for stuff like oil, gas, or minerals. But here's the kicker. It only kicks in after a company gets the legal rights to look around. And it also covers all the work they do to figure out, hey, can we actually get this stuff out of the ground, and can we make money doing it? That's the sweet spot for this rule. This is really the key to understanding the whole thing. IFRS 6 operates in a very specific window of time. So, step 1, before you even have the legal rights to explore, IFRS 6 doesn't care. That spending is just an expense. Step 2, once you get those rights, bam, IFRS 6 applies. This is the treasure hunt we've been talking about. Then, step 3, the moment you prove that what you found is actually viable to extract, IFRS 6 gracefully bows out. Other rules take over for the development stage. So you see, it's just for that supercritical, uncertain middle phase. Okay, part 3, from cost to asset, or turning expenses into actual value on the books. Now, this is where it gets really cool, at least from an accounting perspective. IFRS 6 basically gives companies permission to take all that cash they're burning through during the search, and instead of just writing it off as an expense, they can actually count it as a potential asset. A really big deal. So what exactly can you bundle up and call an exploration asset? Well, the standard is pretty clear on this. We're talking about the cost of getting the rights to explore in the first place, all those geological studies, the actual exploratory drilling, trenching, taking samples, basically the whole shebang of figuring out if you've got a commercially viable find. All of that spending can be packaged together and put on the balance sheet as an asset. And these assets come in 2 main flavors, tangible and intangible. Tangible is the easy stuff, the things you can actually kick, like the trucks and the drilling rigs. Intangible is the stuff you can't touch but is incredibly valuable, things like the legal rights to drill or all that precious geological data you've gathered. The really important rule here is that a company has to decide how they're going to classify these things and then stick to it. You can't just change your mind whenever you feel like it. Consistency is key.
All right, Section 4. This is the big one, the moment of truth, impairment. It's all about facing the financial facts. Because, what happens when the treasure hunt fails? What happens when that map leads to absolutely nothing? This is where IFRS 6 gets really serious.
Because a company just can't pretend a failed project is still valuable. That's the whole point. This is the crucial safeguard built into the rules. You can't just keep a dead-end project on your balance sheet forever, pretending it's a valuable asset. IFRS 6 forces companies to ask the hard question. Is our treasure map now completely worthless?
And the standard gives us a list of pretty clear red flags that say, hey, you need to check this. For example, are your rights to explore about to run out? Have you decided to stop spending money on the project? Have you just plain not found anything worthwhile? Or maybe the worst one, your own data is telling you that even if you find something, you'll never make your money back. If any of these pop up, a company has to test for impairment. This is so important because it prevents them from misleading investors by keeping a dud project on the books.
Okay, on to our last section, number 5, what companies must disclose. This is all about the rules of transparency, because if you're going to be capitalizing all these costs, you'd better be crystal clear with your investors about what's going on. This is the final piece of the puzzle.
So, what do they actually have to share? Well, they've got to lay out their accounting policies, basically tell everyone the rules they're playing by. They need to show the specific dollar amounts for their exploration assets, liabilities, and expenses. They have to detail their cash flows, both operating and investing, and importantly, they have to report these exploration assets in their own separate category. The whole point is to give investors a completely clear window into the company's treasure hunting operations.
And really, it all boils down to this. This is right from the standard's objective. The goal is to help users of those financial statements understand the amount, timing, and certainty of future cash flows. Notice it says certainty, which also implies uncertainty, right? IFRS 6 isn't about promising a successful discovery. It's about making sure the story of that search, whether it succeeds or fails, is told honestly and clearly. So let's leave it with this thought. As the world is scrambling for new resources, new energy, new minerals, how do you think rules like these actually shape the game? Does having a clear rulebook make companies more willing to take those huge financial risks to make those bold bets? Or does the strictness, especially around impairments, make them play it a bit safer? It's a really interesting question to think about, and it has huge real-world implications. Thanks for tuning in.